Good afternoon and welcome to the Future of Finance. Today we will discuss it is time to stop wasting money on a failed and a broken approach to defeating financial crime. I shall now pass you over to Dominic Hobson and our panel. Thank you.
Hello everybody, I'm Dominic Hobson, co-founder of Future of Finance. Welcome to our webinar, It's Time to Stop Wasting Money on a Failed and Broken Approach to Defeating Financial Crime. Unfortunately, I haven't found that many people who agree with this proposition, so I hope you will indulge me as I try to make the case. I heard last week that US banks are spending $9 billion a year on fraud prevention, but still losing $40 billion a year to fraud. That's a negative return on investment of 450%. Yet somebody said to me, well, think how much worse it would be if banks were not doing anything at all. And others said to me, oh, the losses are baked into the operating model. Fraud's just part of the cost of being in the banking business. Now, to my way of thinking, a return of minus 450% makes warfare, a very topical issue, look rational. Now, it's hard to get accurate, comprehensive and up-to-date information on what the global banking industry is actually spending on know your client, anti-money laundering, countering the financing of terrorism and sanctions screening. But if the top 900 banks tracked by McKinsey are spending 3.1% of their revenue on financial crime compliance, as a Refinitiv survey found 4 years ago, banks are currently spending $178 billion a year on this problem. If the losses are 3.5 times as big as the American experience suggests, they're losing more than $800 billion a year. That's probably an underestimate. After all, it doesn't even include the fines they pay for compliance failures or the spending on compliance in other industries, such as asset and wealth management and insurance, or the knock-on effects in terms of business not done, financial exclusion, and exclusion of people and businesses from the world trade system. Not to mention the material and psychological cost to the many retail victims of criminal fraud and money laundering, and the consequent reputational damage to the banks themselves when they refuse to make those retail customers whole. Only this week, a British newspaper published information leaked from a major global bank that it said showed that bank had harbored the hidden wealth of clients involved in torture, drug trafficking, money laundering, corruption, and other serious crimes. Now, many of those allegations dated back decades, but as the bank rightly pointed out in response, it has more than kept pace with banking regulations designed to prevent exactly those sorts of things. The problem, in other words, is not that the bank is not compliant, it's that the regulations are quite useless as a method of dealing with financial crime. They may even, in my view, be making it worse. It's increasingly difficult to dispute that KYC, AML, CFT, and sanction screening has become a massive but useless tax, not just on banks, but on economic activity as a whole, without having any serious impact on financial crime. One close student of anti-money laundering has described it as possibly the least effective anti-crime measure anywhere, ever. The United Nations Office of Drugs and Crime has estimated that just 0.2% of the proceeds of crime end up being seized. So why do banks continue to do something that palpably doesn't work? To my way of thinking, there are only two plausible answers. The first is that, like arms manufacturers in a war, a large number of people are making a very good living out of an essentially destructive activity. In short, there is a compliance equivalent of the military-industrial complex. And I can definitely see why chief compliance officers like the status quo. The work is not only well paid, but it's demonstrably necessary. I can also see why vendors of KYC, AML, CFT, and sanction screening data and data services like it too. There are vast and growing budgets to them to tap. So a kind of groupthink in which the regulators and both the demand and supply sides of the compliance industry reinforce their belief that the existing approach to financial crime is valid. That groupthink is bound to take hold, and changing such remunerative beliefs is, of course, intrinsically impossible. The second explanation I can think of is that the $178 billion being spent by those 900 banks is not in any serious sense a crime-fighting budget at all. It's an insurance policy against being accused of a compliance failure, or even of being fined for suffering from one. In short, it's not a solution to crime or a cost of doing business, it's merely a box-ticking exercise, a metaphorical bung to the regulators that their demands are being taken seriously, a way of ensuring that they remain members of the groupthink. And why would regulators complain about that? They too can be claiming to be doing good work, even better, to be doing it at the expense of shareholders, not the expense of taxpayers. So it makes sense for the regulators, as it does for the regulated, to be measuring activity, not outcomes, because outcomes are much sterner tests of whether or not you're doing a good job. Regulators can even fine banks for not for actually laundering money, but for breaking money laundering rules. So it's not surprising that every country on earth supports the 40 FATF recommendations on AML and CFT. Who would want to advertise their country as a rule breaker? What I fail to understand is not why chief compliance officers and regulators like the status quo, but why chief risk officers and chief financial officers at major financial institutions think that squandering, 20% of their total revenue on a failed and broken process is an acceptable price to pay for being in the banking business. Perhaps they see it as a useful barrier to competition that is well worth paying. But then what do I know? I'm just a cynical journalist. I may, of course, have all of this completely wrong. To put me right, I'm joined by 4 thinkers and experts in the field. Raisa Manning-Armata is Head of Regulatory Affairs at ID Now, the Identity Verification as a Service platform, which a wide variety of companies use to onboard clients as painlessly as the KYC, AML, CFT, and sanction rules will permit. Bertrand Fong is the founder of Secretariam, which has pioneered new combinations of hardware and cryptography to protect the privacy of sensitive data being processed or used in computations in the cloud, a capability now being applied, incidentally, to CBDCs. Rito Grunenfelder is an independent IT advisor with long experience of technological aspects of KYC, AML, CFT, and sanctions screening compliance in the banking industry. David Hannon is head of financial crime in the Business Solutions Group at banking software vendor Temenos, where he specializes in financial crime detection and investigation in the banking and insurance industries. Now, in addition to our panelists, we do, of course, also have you, our audience, and the 5 of us encourage everybody watching and listening to submit questions and comments throughout this webinar by using the Q&A or chat functionality on your Zoom screens. Rest assured, I won't be saving those up to the end, but I will answer them as we go along, so you can, if you wish, be an integral part of this discussion right from the outset. Now, I'd like to begin our discussion proper by asking 2 of our panelists whether they think I'm being too cynical. If I match, for example, the financial crime compliance costs named by Refinitiv, which was 1.28 trillion, against what they estimated, the same organization, Refinitiv, estimated with the losses, it was 1.45 trillion. We're actually in a situation where the costs of compliance are almost the same as the costs of financial crime. We seem to be recovering. There was that figure from the UN of 0.2%. Other estimates range between 0.05% and 1.3% of money being laundered is actually picked up by this vast apparatus of compliance checks. And then there's this $26 billion of fines which banks have paid for various compliance failures. There are lots of other costs we don't talk about, like the collateral damage to world trade. Look at the destruction, for example, of the correspondent banking industry due to people not being willing to take the risk of being found on the wrong side of a financial crime compliance investigation. That excludes lots of perfectly legitimate people and perfectly legitimate businesses from taking part in world trade. Then there's the erosion of privacy as millions of people get investigated. Hard to put a number on those, but it seems to me that this is an expensive, useless, and intrusive activity. Am I being too cynical? David, perhaps I could throw that at you first and then ask Raisa for her thoughts on it as well.
Okay, well, I suppose the first onset to that is as somebody who sells solutions to stop those costs being so high. I don't think people are spending enough. Okay. Mm-hmm. But certainly the return, even at the best of the best performances, is not enough. A lot of that is because whatever about the technological improvements that have been made by multiple vendors globally over the years, whatever about the power of cloud to reduce your own site costs of all of that, the process thinking is still the same. I mean, I use a perfect example of when people do their KYC assessment of somebody, if their risk assessment goes from medium to high, or if they just come in as high, they generate an alert, they investigate it, and larger banks have hundreds of people investigating those alerts, but there isn't a regulator in the world that demands that you report that. So those hundreds of people are straight away a waste of effort. They could be focused on the true and more accurate alerts, or the ones that actually drive business value, such as fraud, where the money's being stolen. They can investigate that efficiently. They can do that efficiently. They can retrieve the money faster. So from our perspective and from my experience is We look at the world the same way we've always done, and all we've done is apply technology to make everything we've done before faster at a higher price, as opposed to shifting the way we think.
Mm-hmm. Maria, am I right? We're spending hundreds of billions, probably trillions of dollars, and we're getting either a negative or very low return on it. Am I too cynical?
You're partly right. Yes, we are spending exorbitant amounts of money. Whether you're cynical or not, I think the question and answer is more complex than that. And I think the discussion today will definitely get into the different aspects of it. As a KYC solution provider, obviously I have the statement to say, yes, you need to spend the money on it. It's important. Fraud is a very big problem. At the same time, I think listening to what you are introducing into the conversation, I think that there's also discussion and thoughts need to be put on cost benefit analysis. What are the obliged entities investing in? Do they understand what they're investing in? Is it only relying on the technology to solve the problem? Is this compliance just for compliance sake? Are they just trying to meet and tick the boxes, as you said earlier? So I think the more information that we have, the more communication that we have, an exchange of data on users, data on fraud, I think these obliged entities will be able to make smarter decisions and have a management process that involves technology, which is very important. As we've seen over the last few years, digital services are not going away, they're increasing. So the solutions are here, the problems are not going away. I think maybe one way of looking at this topic is to understand how are we better managing the responsibilities with the tools that we have, and how can we improve on that and make better management decisions of this customer process.
Mm-hmm. Now, a LexisNexis survey I read, it was a 2021 survey of the cost of compliance, said customary due diligence accounts for 66% was the figure they gave of compliance costs, and half of that was identity checks. And those identity checks alone account for 25% of total financial crime compliance costs. So it's actually proving very difficult to find out whether people are who they say they are. This is a major source of cost. You, David, mentioned very high level of false positives. So whatever data people are feeding into their machines isn't of requisite quality. And then on top of that, you have all the costs of putting it right. So if you have a false positive or your identity data is inaccurate, you then have to fix it. You have to remediate it. And LexisNexis says each remediation they do costs another 20 hours of somebody's time. So my question is, and maybe Rita, you have some thoughts on this. Is this a question, we'll come back to the identity thing, and I'd love to hear what you have to say about this, Rita, but are we talking here really about data quality? All these data vendors supplying data to software providers and other service providers who are trying to help banks manage this problem efficiently. Is the data the problem? And if it is, should we be thinking about a completely different approach to this? Rita.
If I take it from my experience, which goes back more than 30 years, data are the core of the issue. Let me give you an example. Call a bank and tell the bank, you might have an issue with XYZ, which is one of your customers. And look how long it takes the bank to identify how many different products this XYZ has. How often these data over various data vendors are residing in the bank. These are all costs which are even not put in all the KYC, AML stuff, etc. So data quality is definitely a big issue. And the issue is even increasing when banks now also go towards the cloudification with data lakes, etc., with unstructured data, etc. So to my experience, data are a big issue, and there's a lot of rubbish data around which you do not know that they are rubbish data. So they have first to be identified as rubbish data.
We've had a comment already from a member of the audience. Richard Parler says the key issue is the policy move from follow the money to boil the ocean. it's ineffective, inefficient, and misguided. Now, Bertrand, you may have some thoughts on this. You've heard what Rito said about the problems with data, but there are probably also problems with systems and with processes as well. These are probably incomplete, they're probably siloed, and yet you've got, as Richard Parler says, you've got regulators saying, well, actually, it isn't good enough just to try and follow the money. You've now got to pick up these potential criminals in advance and be preemptive and proactive. And so people are just being overwhelmed with an impossible task, I think is what Richard is saying. What part do you think these legacy systems, data sets, processes play, Bertrand, in the...
I think it's very important. So I'll be talking from software engineer background, not a compliance officer. We've been working with many banks on KYC data quality since 2018, and they all have this big problem with different jurisdictions, different data stored by different of their entities. Most of the banks today are international banks. So you're talking to one bank, but actually you are talking to dozens of different sub-entities that each of them have to have their own system and spend the cost to keep this system up to date all the time. And they can't share the cost of that because everything has to be siloed in different jurisdictions. So it's a big investment from them to actually improve all of this system all over the world, and it's very difficult. One of the very interesting part and very interesting approach that the banks have had with our technology is that they've decided to benchmark the quality of that data by, in a fully anonymous way and fully encrypted way, just checking with their competitors, either sub-entities or large competitors, if they had the same data on different customers. And out of the report they would get, they would know that how many banks would have the same data as themselves, and it would give them a little bit of idea of the quality of their own system and give them the needle in the haystack where the potential issues they had. Some of them found out of that they had some process issues, that some of the way they were treating some codes were actually inaccurate and ending up in having completely wrong data set in their databases. So it's helped them a bit, but the challenge is big, absolutely. And
just to be clear, Bertrand, are you saying that it would make sense for banks to start sharing data, including data about financial criminals?
Yes, absolutely, but they can't do it.
Why not? Is it a political decision not to do that, or is it technical?
It's a regulatory issue. You as a bank, you cannot disclose who your customers are. Therefore, you cannot share the data with other banks because you will instantly disclose that information. On top of that, some individuals, under the regulatory laws like GDPR or CCPA in California, you cannot share names like that. You need to have that consent. So it's like that extremely complicated. Okay. And this is why there is a big wave of privacy enhancing technologies coming up that actually allows you to do that in a fully encrypted way. And therefore the information itself is not shared, but only insight on the information is shared. And that's actually very, hopefully going to change how it's being worked.
Okay, now Reza, this sounds crazy. We've got GDPR contradicting FATF and the Anti-Money Laundering Directive. These regulations are pointing in different directions. I mean, is it realistic to think of banks as starting to share data? Is Bertrand right that that's kind of impossible idea? You were nodding, is what I was picking up.
No, I would. Yes, it's a good point. What I was going to add to Bertrand's comment was, yes, you're right. It's also the quality of the data, but also these fraudsters are quite aware of the different systems across borders, and they take advantage of this. And so quality of the data and knowing that there is fragmentation and differences across how even suspicious activity reports are handled and the frameworks and templates for that all add to this burden and this problem. And yes, GDPR and privacy issues are important to consider, but the GDPR also does have flexibility and is intended, especially in cases for anti-money laundering, to be able to collect data and collect that data for the purposes of risk management. So there's a lot that needs to be addressed. We do have regulations and frameworks that are being drafted at the EU level, at national levels that are being worked on. So it's sort of like an ecosystem that has different gears. And when the gears finally get together and there's more streamlining and symmetry, I think some of these issues definitely will be addressed. Mm-hmm. And this is what the fraudsters can take advantage of, because they know the weaknesses.
Mm-hmm. David, help me here. I'm hearing that here we are, banks are spending trillions of dollars on this problem. They're not solving it clearly. The data is inadequate in quality. Their systems are out of date. They're not prepared to share it. GDPR prevents them sharing it, even if they were prepared to share it. Something else I'd like to throw into the mix, I'm sure you've got a view on this, is that one of the other things they said in that LexisNexis survey I pointed out about the 66% of false positives was that 70% of financial crime compliance costs are actually people. It's compliance officers. It's this long payroll doing all this useless work, as far as I can make out, or ineffective work, should we say. So you're a technology vendor. Tell us from your experience how large this problem is of legacy systems, legacy processes, and throwing people at problems, rather than trying to think the problem through from a different perspective.
Yeah. Well, first off, I'd like to say that there is a difference of opinion about GDPR, data privacy, in this regard, right? There's a specific FATF recommendation, I think it's 11 or 12 off the top of my head, I can't remember which one specifically, that outlaws all signatories to FATF from having data privacy laws that get in the way of anti-money laundering and terrorist financing. So GDPR is a lower quality regulation than those of AML and CTF from that regard. And that's why people keep it in different systems. They don't keep it in the core systems, which generates a secondary silo.
GDPR is a law, though, and the FATF recommendations are kind of just recommendations, aren't they? So
yes, but they're transposed into law. They're transposed into law in the EU, money laundering directives and so forth. So as signatories to that, each of the FIUs has to defend the FATF recommendations. So it's, as I said, it's open to interpretation. Our view on that is, and a progressive conversation with the regulator from any of my clients' experience would say the same thing. Sorry, if you're a terrorist, you don't have a right to be forgotten. Forget about it. That's the only thing you do, forget about, right? But in terms of coming back to your primary question, in terms of the efficiency, as I said, people often measure false positives, for example, as a percentage of the raised alerts, and that has no effectiveness measurement in terms of the overall volume of payments. I mean, 10% of nothing is still nothing. 90% of a lot is still a lot, okay? And then we see false positive rates, say for sanction screening, which is the really measurable cost. They should be 2% or less. And certainly from our experience of implementations of our solutions, that's what our customers expect to get. And if you use those examples earlier, talking about the huge numbers of people in large banks, there's thousands of people involved. Well, like according to Dow Jones, in a tier 1 bank, 95 hits a day. Okay, that's not even 95 payments a day. 95 false hits a day is an FTE. So realistically, if you're moving from the 5 to 7% surveys down to 2%, you're going to save 4,000 or 5,000 investigators just doing that. Okay, so that, I mean, there's your payroll at an FTE cost of $150,000 a head. Okay, there's your money being wasted. They're not necessarily always looking for the right ways to make the systems more efficient. They look to auto evaluate false positives using old style AI. This industry's been using AI for 20, 30 years. It's not called big data anymore. It's not called predictive modeling anymore. It's just called AI, but it's still the same underlying mechanisms that have all been used in different ways.
Now, Richard Parler has referred us to an EU task force report on improving AML effectiveness. He also points out one of our leading banks has more people looking at false positives than there are officers at the City of London Police or Europol. He thinks we should train them on investigations, amend the algorithms, start setting OKRs as well as KPIs. I'm not sure what an OKR is, but I'm sure one of you might know. It's an objectives and key results. So actually, yeah, outcome-based approach to doing this. Rito, perhaps you could help us. You've heard what David had to say. You've heard what Reza had to say. What do you think is going on inside these financial institutions, which leads to this triumph of process over outcome? Are they kind of gold-plating compliance in order to reporting these suspicious transactions? Seems to be a very clear example of that, where anything that looks even remotely suspicious gets reported, and so they're completely overwhelmed by the volume that they're seeing, and they're not actually shifting through the data in a very intelligent way to satisfy Richard Parler's OKRs.
I mean, from this point of view, the problem is in fact still the same as 50 years ago. We have to identify who does wrong. That's still the same.
Okay.
However, when we look in a bank, how many applications does a bank run? The answer can be 250, the answer can be 5,000. I just give you a span of different banks. So in many of these applications are data of customers. And these data have, in the end of the day, to be checked. So how efficient can this be done? These are many different systems, 3,000 vendor systems. Up to 3,000 vendors are in a bank. So now you can take out maybe 80%, and 20% of the vendors have, in the end of the day, something to do with the accuracy of the data and all. So when we talk about all this, we talk about one layer, which is the visible layer, but underneath is so many things. And that's the reason why it becomes so difficult. So in the end of the day, the name of the game is automation, automation, automation. And then the cost comes down and the efficiency goes up.
They're spending so much money on box ticking compliance, they don't have any money left to rebuild their systems. Bertrand made this point that actually you could do this a lot better, but there's no money to do it because it's all being wasted on this useless process. Am I being too cynical? If they just stopped doing financial crime compliance for a year and spent the money on reordering their systems, would we get a better outcome? It's an impossible question to answer. I appreciate that.
No, well, not from preventing a financial crime perspective. No, of course not. That's like just opening the keys to the safe and leaving it at the front door and saying, take the cash. It has to be done. Okay, it's always going to be a game of Tom and Jerry, and there's always going to be degrees of some people are smarter than the prevention systems. But if you open the floodgates, is it going to get worse? Yes, because every opportunist will be out there doing it.
Mm-hmm. So if we talk a little bit about the obstacles that prevent a change here, we've already discussed legacy systems, legacy processes, difficulties of collaboration, data quality, and so on. But what about the interests that are actually at work inside these organizations? I might put this to you, Reyes, just very crudely. Is everybody too busy complying to think innovatively, to innovate in this area?
That's a good point. Yes, there is a lot of pressure to comply and to get it right, and to also have the best user experience, right? To reduce costs. So there's so many factors involved in how you want to get it right. What was the first part of the question again?
Well, the question I'm really asking you is, and I think you've answered this, is that people are under pressure. They're spending so much time trying to avoid getting fined by the regulators and making sure they tick every box. They don't have time to actually think about how could we do this differently. Richard Parler's point here, objectives and key results. He says they're what lie behind the growth of the major US data companies. It's a great methodology, not in widespread use yet, and certainly not in the financial crime area. In other words, if we switched away from process, which is where all the effort and money seems to be being spent, towards the outcome, something I said at the beginning. And what is the outcome we're seeking? To defeat financial crime. It's manifestly not working. So how do you, given that you can't, as David said, simply give up for a year and reinvent yourself, somehow you've got to, in parallel, change the method you're using. And I'm trying to ask you, I suppose, whether you think there is a methodology here to change the, while the airplane's in flight, repair the engine and switch to a more outcome-based process. I'm sure Bertrand has a view on this too, but Raisa, you may have something to say on that.
Well, I mean, from our perspective, as a solution provider, our mission is to make this whole connected world safer. So for us, we have one objective, and it's to help those obliged entities meet that need. We're one part of the solution, we're one part of the system. But if you're going to be flying that airplane, you have to know how to fly it. At the same time, you're doing it as you're building it. There's a lot of pressure, and it's very complicated. So it's paramount that these entities understand, what is the technology being used for? Am I investing it in the KYC process? Is it more important for my bank to be investing it in the monitoring and screening? And how am I getting the best out of this? You can't just rely on the technology alone. It still needs people, training, staff. There's a whole process that goes with it. And I think part of the mistake is to just tick the boxes and say, well, we have this AI and machine learning. It's used for helping us track the false positives. And then all of a sudden, all you're doing is coming up with false positives. And then that weakens your suspicious activity reports. So that defeats the purpose. So there has to be a smarter way of understanding what you're investing in, understanding where the technology is going to be used and how you integrate it with the rest of the whole staff, the banking system, the whole process. And it's going to be different for different banks. There are banks that work across different countries. There are smaller banks, there are fintechs, and one size solution doesn't fit all.
Bertrand, is there a magic bullet here where banks could look at their existing data sets and data flows and data sources and look at their existing systems and just do it better without necessarily having to vastly inflate their budget or completely reinvent the bank? And as Raisa says, the banks have lots of different sizes with lots of different budgets. But let's just stick to, I don't know, the 900 biggest global international banks. Is there a magic technological bullet here which could?
I don't think so. That's very unfortunate. I don't think there is any magic bullet for the bank. It's a very tough system to improve. And bouncing back on what Raisa just said and Reto said earlier, what's very interesting at the moment is to see the fintechs, to see the crypto exchanges that are facing also like rising compliance cost. And looking at their strategy, they want to automate the full process as much as possible because they've got different business models, they've got different margins, so they can't actually keep these costs growing. And so they're looking at that from fully automated perspective, user identification. And it's extremely complicated. If you look at for example, machine learning AI for passport detection, there's 3 big technologies around the world that provide their solution for all the KYC providers. And I was talking with a regulation officer 2 days ago, and he was presenting me a fake ID. Was looking very good, but the font was wrong. And instead of having the British background, it was a unicorn. And his passport had passed all of the AI-driven automated process of all of these crypto exchanges. So yes, everything has to be automated, but there is no such thing as a magic solution because each small steps of this KYC process, of these waterfalls processes, are themselves very complicated, each of them, and it will take time. It's not just for the banks, but for everybody that is working with digital identity to improve the system to reach a point of high quality. So unfortunately, no, that's the way it is.
Well, I'm glad you brought up the question of cryptocurrency exchanges, as I was thinking in preparing for today about cryptocurrencies and non-fungible tokens in particular. I'd sort of assumed non-fungible tokens had just become a sort of money laundering machine because all you needed to do was do a squiggle and put it in a PDF and you could sell it to all your people who wanted to launder money. But then I read this report which Chainalysis put out, I think it was last week, pointing out that although the value of financial crime in the cryptocurrency sector has increased, and it's not insignificant, I think it was like $15 billion, as a proportion of total activity in the market has actually never been lower. And there were a couple of instances of this. The two individuals were arrested for that Bitfinex hack back in 2016. And I read something this morning about the individual who stole $9 billion from the Dow, also back in 2016, has also now been identified. So, as you say, Bertrand, they are increasingly aware of in that sector of their compliance responsibilities, and they're spending more money on it. But they seem to be getting better at it as well. So, I don't know. I would have asked you the question, has cryptocurrencies and NFTs actually made money laundering worse? I'm wondering whether we might actually learn something from them. What do you think, David?
Okay, maybe I'm getting old and cynical.
You can't be more cynical than me, I can assure you.
No, I'm not so sure about that, those who know me. If they're to be regulated institutions, if cryptocurrencies are allowed to be traded, they have to have the same regulatory oversight as any other financial intermediary processing money. Because crypto, whether you agree whether it's a currency or not, I don't. I believe it's like betting on a horse in the starting blocks, knowing it's never leaving the trap, and you're going to sell it again because it's not actually something that moves like cash. But as something, as a holder of it in any shape or form, as a mover of it, you have to have the same controls as regular financial payments. I don't see any other alternative to that.
My point is here, and this is the point I think which Chainalysis is making, is that blockchain technology is actually more transparent than the traditional financial system. You can actually find people. This is ironic about Bitcoin in particular, but you can find people more easily in crypto and NFTs than you can in the traditional financial system.
Well, certainly than in cash, yeah, because they know not what they not know, and there's usually an audit log lurking around the world somewhere. Yes, but it has to have the same oversight, same controls, because otherwise it's just systemically dangerous to the world. You wouldn't have to be worried about how much is stolen, because it could just evaporate because somebody pulls the wrong set of plugs.
Agree. Yeah. I think you're right with the blockchain, but also if you don't KYC the wallet holder and it gets transferred anonymously, then there was no purpose then the fraud it's too late. So I think we do have to consider this as an equal opportunity for such regulations to protect people who really are legally holding an NFT and wanting to trade it properly or exchange it. It's such a nascent new area of technology, but the crime or the traditional art crime and money laundering is an old application, and to use it in this new digital world, it's open and ripe for taking advantage of. Absolutely. So there should be a regulatory framework around that, and KYC is a good place to start.
Mm-hmm. Yeah. And I think basically there's something like I see it in so many organizations over the years. People do a comprehensive, what they think it's a comprehensive KYC during onboarding, and that's not the same approach they take thereafter. So they're duplicating or triplicating or replicating work again and again and again, which not only costs money, but also upsets customers.
Mm-hmm. Can we think a little bit about what might an alternative approach to this problem might be if we just set aside questions of budget and timing and the difficulty of changing the engine in mid-flight and so on? Now, Raisa, your organization is called ID Now. We've never made any secret at Future of Finance. We think digital identities could be the solution here, partly because they put the onus on the consumer, the onus on the corporation to prove who they are. And if you can't prove who you are satisfactorily, you're cut out of the system. I'm sure, Bertrand, you have some thoughts on this, but Raisa, tell us, am I switching from cynic to sort of undue optimist by thinking that digital identities are the answer? I was trying to think of the name of the character in Candide, the French novel, which Bertrand will remind us of in a minute. Pangloss. Am I switching from cynic to Pangloss by saying that digital identities are the answer?
It's a very good question. It hasn't fully evolved. If we're talking, for example, about the EIDAS draft regulation that has put out this initiative last year, that there should be a digital identity available for all Europeans that can be stored in a digital wallet. This is an incredible move towards harmonization. And moving in a great direction, but there are so many moving parts to this. Ultimately, we have to deal again with data privacy, with security. We need the European Commission to come up with a technical framework. So it's all still quite evolving, but definitely it's going to be a game changer in this whole ecosystem for sure.
Rita, I'd like your thoughts on this, but before you give them to us, Bertrand, what is your view on digital identity? Is my preference for putting the onus on the user of the financial system to prove who they are one which is likely to get traction? Is it a good idea or not?
I think it's a good idea. And for individuals, but also for legal entities. And if you look at a very big initiative from GLIFE, the Swiss-based Legal Entity Foundation, about 2 years ago, they started to issue digital certificates and with the legal entity identifier in there, so that a company could issue a digital signature that embeds their legal entity identifier from GLIFE. And that's very powerful when it comes to doing KYC, because you can authenticate yourself with digital signature the same way you would do with a wallet if you were to exchange pay with a digital currency. So not only it's coming from the cryptocurrency system and ecosystem, but it's also there as well for the investors, for the legal entities, for the banking system really to be used. One unfortunate thing is, like, we've been working with GLIFE for years, and as of today, we have not seen a lot of traction from this really disrupting feature they've released a few years ago. It is coming, I guess. Yeah.
Rito, it's clear to me that banks, or indeed asset managers, either wealth managers, are not convinced that digital identity is part of the solution to this problem. What do you think does that tell us that the solution is wrong, or that the banks don't believe in it, or what?
I think when we talk about digital identities today, then we think primarily in a context we can replace the passport by something which is digital and do it like cryptocurrency exchanges doing KuCoin or Binance or Kraken or whatever. When I look at them, they still have a lot of deficiencies, can all be solved, of course. But when we look at the privacy aspect, and I talk to the banks, I doubt this is a solution by tomorrow. In the long term, it will be one. But I'll give you an example. If in my digital ID is written, I am a passport holder or a citizen of this and this country, and I'm at the same time also a US citizen, so also taxable in the US, then my country and the US have to have an agreement that this digital ID has to work in both countries, etc., etc., etc. So I think it's an organizational issue which still needs a lot of really proper work in order to introduce it in a viable system.
Mm-hmm. But as Reyes has pointed out, there's no regulatory objection here. The European Union's got this standard schema out there. The UK government's published a digital identity framework. FATF, the authors of these 40 recommendations, have published a paper on digital identities and said, if you follow these attributes and this pattern, you will satisfy whatever recommendation 11A or whatever it was you were referring to this, David, which obliges you to identify the beneficial owner of a financial transaction. So the regulators are kind of signaling that they would approve this, but I think you're right to say that the banks are not enthusiastic about this. And I wonder if that's just a question of understanding. Do they understand what we mean by a term like self-sovereign identity or not? Raisa, is understanding a problem?
Definitely understanding is an issue. Like the other guests have mentioned, there are the legal aspects, There are the technical framework aspects, the security aspects, the interoperability of this whole wallet, the relying parties. Will they be the banks who are the wallet issuers, or will they use a wallet that's issued by someone else? What about the liability? What about the whole idea of a self-sovereign identity? How sovereign will it be? Yes, I can choose whether I want to show you what my age is, or whether I need to show you more information to open up a bank account, or to do my taxes online, or some other service. So there are a lot of definitions of what self-sovereign identity is. How self-sovereign will it be? These are all things that are yet to be decided. Yeah.
David, you're not in your conversations with banks, they're not volunteering that they're interested in digital identity as an alternative. Is it part of your strategic thinking at all at Temenos?
So we don't sell data. We sell systems that talk to data and process data. So we would talk to someone like ID Now, etc. But for me, from our financial crime offering, we expect that data has been verified before we ever see the customer. They shouldn't become a customer, so if they're not really relevant to me, I will then score them for money laundering and terrorist financing. But I kind of alluded to earlier, is people waste money investigating that outcome, as opposed to actually then using that outcome accurately or not in a timely manner to actually monitor financial activities. So basically, you in your risk-based approach, you should say, if it's imperfect information, you're high risk and everything becomes suspicious. Okay, but focus on the money, not on the actual, not the full identification of somebody. Because they won't necessarily. There is no such thing, for the most part, as a money laundering defined customer, apart from a few sanctioned ones. It's what they do is the problem. It's not the person. It's what they do, apart from the sanctioned entities. But just because they happen to come from a high risk jurisdiction and work in the gambling business and they're a cashier in the gambling business doesn't mean that anything they do is money laundering in their current account, for example.
Mm-hmm. Now, clearly, financial institutions of all types. So we've talked about data more than once as being part of the problem here. But every financial institution is under pressure now. Banks, obviously, from open banking, which is taking off around the world. That's morphing into open finance. It will eventually morph into open data. So firms, if you're in the regulated financial services business, you're going to have to improve your grip on your data anyway. Now, is it part of the thinking of I don't know, chief compliance officers, or more importantly, perhaps chief technology officers, chief information security officers, maybe chief risk officers, or even chief executive officers of banks, thinking, well, actually, one of the benefits of cleaning up and getting a better grip on our data might be a much cheaper, more effective, better outcome financial crime compliance process. Rito, do you have those conversations with banks?
It happens, these kind of conversations, quite often, but frankly and honestly, the question is, what is the benefit? Or if you want to change your data landscape, then David can certainly talk about much more than I. Changing the core banking system is just one. This is already 3 years, at least. And changing the entire data landscape, I can just give you an example. I was involved in the project for 7 years to clean up the entire data landscape of the bank. 7 years.
That's enough time for a famine or a plague of frogs, isn't it? Yeah. So Bertrand,
that's enough.
Yeah, Bertrand, is there a magic bullet here? Is there a technique for banks to get on top of their data which doesn't cost the earth, and a byproduct of which might be a better handle on identifying financial criminals that are trying to make use of the services of the bank?
Maybe. If you put yourself in the shoes of a big bank that has hundreds of thousands of customers, sometimes millions, they know they've got wrong data, they know they've got anomalies, and they know that regulation changes, a passport expires, people move address and so on. So it's a constantly changing data set they have. And finding the anomalies, finding the needle in the haystack is extremely costly. That's why they got so many people working on that. Banks at the highest level are looking for cost reduction, and this has been for years one of the department where they want to cut the cost. So we've been talking to like top management of the largest European banks and American banks, and they were all willing to really invest on something that could allow them to reduce the cost. Definitely, to answer your question. And yes, there is some magic bullet is cooperation between the banks, sharing the data, as we were talking about earlier in this conversation. The banks, if they all work on their own, they will never be able to find complex money laundering patterns and so on. So data has to be shared across borders, across jurisdiction, and this is very complicated, both for regulatory reasons, privacy reasons, data sensitivity reasons as well. Mm-hmm. Hopefully, new technology can allow them to bypass that, but it's really new. Our technology, for example, at Secretam, is only possible since 2016 when a new generation of hardware was released. So, even the banks that have been looking at it since 2018, just 2 years after it was made possible, it was already extremely early. And we don't see that actually happening at scale before maybe 2 to 3 years. But we are definitely going to the right direction.
Sébastien Grevery has made an interesting observation here. He says machine-readable regulation is a critical step to ensure enforcement is not too variable and subjective. Crypto-based systems are probably a good development for programmable value exchange with embedded regulatory enforcement. So I guess he's talking there about a RegTech solution here, that the regulators become part of a data exchange system. Once the notorious technological debts can be written off in some way, it'll be expensive, I think is what he's saying there. So banks should rethink their core retail systems with legal and regulatory compliance at the core, consumer-friendly products to peripheral level with new cloud API-based business and tech stacks. So at one level, you could, as a retail bank, say, well, let's move over to blockchain and let's put the regulator on the chain with us and they can see what's going on and that'll lower the cost. At another level, you could do something quite conventional. You could move to the cloud, have API-driven data exchanges. But what he's really saying is that banks do need to start thinking about what would be a virtuous circle here, I suppose. So you invest in data, technology, better processes, you cut the cost of financial crime compliance, and you get better outcomes. I mean, is that solution actually available? David, I'm sure you would say yes.
Yay! That's what we do at Temenos. Okay.
What about Sébastien's, cloud API, blockchain?
Yeah, that's what we do in Temenos. We were the first core banking vendor in the market back in 2011 to put regulated financial institutions in the cloud. We've got over 700 institutions globally up on our cloud service. So that's doable. That's there now. That's available. And banks we've seen a rapid shift in banks moving to that in the last 2 years, because it's the only way they've been able to adapt with the normal operation interruptions of COVID, So that's the only way they've been able to keep their businesses going and adapt to a changing world. Yes, if a bank wants to do that, come and talk to us, and we'll show them before and afterwards with our value benchmark how they can achieve a return on that and what they should be expecting.
Mm-hmm. Okay, so Sébastien, there's a big consulting assignment there for you with Temenos, I think, definitely. Ewan Grant says, we've just heard about the potential magic bullet of at-scale data sharing between the big banks. Agreed. And he also says, are we overusing the word data? Should we not add ideas, feeding the data and derive from it? Which is a reasonable point. It's about trying to derive some intelligence from these data flows that we're looking at, ways of investigating it, which makes me think, does artificial intelligence and machine learning have something to say about this, Raisa? What do you think? Are banks underusing AI and ML in the financial crime compliance area?
Great point. Yes, the better quality data you have, the more you can do with it, right? So from our perspective, the purpose that we serve is KYC. So we help the banks verify the identity of the person and make sure that the person they're doing business with is the same person that's identifying themselves. So yes, we have seen a major shift in regulations where AI and machine learning are being allowed in the digital KYC process. Working with ID Now, we are a German company, which is now a European company. We've been able to expand with new partners in France and in Germany. And what we've seen from a regulatory perspective is that there are different national regulations on how you can use a digital KYC process. Some allow only a video process, others allow an automated solution where AI is the substantial technology that's in the process. So this shift has allowed us to build our products on a platform. So we have different products for different regulations across the countries, and the AI has significantly been able to help us with fraud detection. For example, there are security requirements where an automated solution has to produce a false acceptance rate at a certain percentage, and our products have been able to exceed those numbers. And so yes, AI and ML can make a big difference. I'm talking about the KYC part. Obviously, there are artificial intelligence tools in the other processes for monitoring and screening and the false positive reporting. So that's something I can't really speak to, but for KYC, yes, it does make a big difference.
Mm-hmm. We're into our last 3 or 4 minutes now. So it might be interesting just to give everyone listening something to take away with them. And that something might be what you think is the best way forward in this area. I think we are agreed that the present system isn't working brilliantly, even if you don't think it's working as badly as I outlined at the outset. So what do you think we should, this is my final question to each of you, and I'd be interested in each of your thoughts on it. What concrete steps do you think we could take to make things, get better outcomes? Rito, perhaps you could kick us off on that. Is it AI? Is it ML? Is it digital identities? What is it?
I think the primary idea is just not to think in tools, it's to think in process, to look overall how it gets better and then to break it down in tools.
You and Grant's point about ideas are more important than process or data. Yeah. Bertrand, what's your thinking? What's the idea you'd like the audience to carry away?
Well, to me, I think standards and regulation is a very limiting factor at the moment, because of our municipal jurisdiction, having to comply with different regulation is very complicated. So having some form of standardization on both the data and the regulation will be a nice way forward to put in place the required automation that will then lower the cost for everyone.
Mm-hmm. Raisa, you've heard think harder. Let's have less differentiation in regulation, more standardized regulation. What would be your idea? Please tell me it's digital identity. I'd love you to say that.
Digital identity is definitely something in the future. There's a long way to go there before we have that framework finished. And the European Commission has a very ambitious project in a short timeline there. So I agree with that. I think what I would add is that we shouldn't have compliance just for compliance sake. That defeats the purpose, and the fraudsters will win that way. I think as we establish more of these frameworks, whether it is the digital identity or just other types of technology that's out there for KYC, we have to have better communication between the private sector and the public sector, between regulators and relying parties, vendors like ourselves. We try to be very involved on that scale. So I think that definitely needs to continue.
Mm-hmm. Thank you. So last word from you, David, before we sign off. You've heard, let's think harder, let's have standards, let's have better frameworks, digital ID, included in that list of frameworks, what would be your solution for the next concrete step that we should take forward in financial crime compliance to get better outcomes?
Make compliance a profit center rather than a cost center. Be cured overnight.
Well, we're certainly not getting a very good return on the investment right now, are we?
No, because
the process will have to change.
center.
If we're getting returns of minus 450% in US
Precisely.
banking, right? It's a long way to go to turn it into a profit center.
But if you turn it into a business enablement function that lowers the risk of doing business, therefore you can undercut your competitors, you can grow your business, you make money. Bingo, it's a profit center. With some regulatory help, of course.
Okay. Well, that's a nice idea to end on. Thank you for that, David. Actually, we moved from minus 450% to plus 450% in a very short order. Sadly, that's where we must stop. I'd like to thank our panelists, Reyes Manning-Amata from ID Now, Bertrand Fong from Secretarium, Rita Grunenfelder, and of course, David Hannam from Temenos. And thank you also to you, the members of our audience, for your questions and your comments. Here at Future of Finance, our next webinar is Thursday, 17th of March, same time, 1400 London time, same place, Zoom. And we're going to discuss in it the good reasons and the bad for taking NFTs seriously, something we touched on today. I hope lots of you can join us then, but for now, it's goodbye from the five of us. Goodbye.
Thank you.
Thank you. Bye.